Thanks everybody for joining. This is the second live impromptu market chat conversation. All right, so let's talk about energy. So it's funny how narrative follows price, as I always say, right? Last year was incredible for the energy sector. A lot of Twitter spaces were dedicated to the idea that energy was going to be the place to be from a multi-year perspective. By the way, I still think it is. But let's face it, all the momentum and FOMO has gone to tech the way this year's played out, and energy hasn't really kind of played out too well so far. Just talk about sort of from your vantage point, what you think is going on with investor demand when it comes to the energy space, the oil and gas space. I'm going to try and show a couple of charts as we're chatting, but lay out the landscape in terms of how you're seeing things.
Well, it's been tough on the private side. There's been a lot less investment. Private equity, these guys have struggled to raise funds. I think we talked about that last time I came on your podcast. There have been some pretty incredible exits finally coming through on the private equity space, a lot of consolidation, which we can talk about. On the public side, it's been out of favor. I still think valuations are, I mean, I'm not an equities analyst, I'm more in the private side of things, but I still think there's some attractive valuations. But, you know, this year we've seen oil prices weaken. We've seen natural gas prices fall off a cliff. They've bounced back a little bit. And I just think that, you know, underlying a lot of this is kind of the don't fight the Fed narrative. People will point back to oil fundamentals and say, look, you know, OPEC's cutting, rig counts finally dropping, production in the US is getting flatter, maybe declining on the oil side. But ultimately with the, you know, the yield curve where it's at and what people are predicting around a potential recession, I think it's just hard to get super bullish in the near term on oil prices with the, you know, with a bunch of indicators saying that there could potentially be a recession looming. Oil typically dips during those. And then, you know, after those, it tends to rip a little bit. If you look at the last few that we've had, obviously the '08, and then even in COVID, we saw oil prices go negative. Then they bounced back dramatically afterwards. So I think until we can see some line of sight on whether this is like a soft landing type of situation or whether, you know, we're going to avert it totally or whether it's going to be a huge recession or, you know, until we can figure out what's going to happen in terms of global demand and what could play out, I think it's going to be hard for oil to break free. I could be wrong. I would love to be wrong there because it helps my business and the companies that we work for if oil goes higher. But you know, we're seeing a lot of consolidation. We're seeing people dropping activity. We're seeing OPEC cutting. There's a lot going on that we can dive into. All
right, so let's get into the OPEC cutting. But before we do, on the natural gas, I mean, it's funny, when I looked at the chart, it actually looks like it could be bottoming maybe after a horrendous period. And I get it, a lot of that's weather related, right? But is there anything else other than weather, recession that's driving, in particular when it comes to natural gas, that sell off and that could be some stabilization here that could maybe cause a catalyst higher? Anything that you're seeing there?
Yeah, I mean, I think that guys still got after it. You know, there was this narrative that capital discipline and guys aren't going to drill, but we saw Haynesville going crazy, people adding rigs. We saw production setting new highs. I think recently, I haven't looked at the supply numbers in a few weeks, but we had dipped below 100 BCF and I don't know where it's at today, but we saw some supply coming off. I think the Northeast is under pressure. I mean, when you get to $2 for natural gas, or you get below that, there's not a lot of reserves that make sense to drill. I mean, guys drill them for other reasons, like they make an acquisition, they have to drill it and bring cash forward. They've got debt that they have to service, although balance sheets have gotten a lot better over the last year in this space. But I think that it was really, you know, weather and then a supply story in terms of a weak winter and then guys just getting after it when people kind of convince themselves, like they always do, that guys won't, you know, drill their way into oblivion. And we just saw a lot of production come on. I don't think that the equilibrium price for natural gas is $2. I mean, I would hope that it's closer to $3.50, $4, but we'll see. I mean, the Northeast is constrained. You know, if Mountain Valley Pipeline, I think Joe Manchin finally got that thing pushed through just recently with the debt ceiling bill. We'll see if it happens, but they got to get unconstrained. We need new infrastructure projects to get more supply on. There's been rumblings around the LNG side that if prices drop low enough in Europe and some of these other Asian markets that there could be bottlenecks there. It's like, if you know, there's definitely a spread that has to be made for LNG to make sense. So look, I don't know what's going to happen. My gut tells me that this is fake. We've lived through it before. 2019 was an especially painful year when prices got really low. And I would just hope that we could stay range bound in the future in kind of the $3 to $4 range. I think that's a healthy range. I think you get above $4, you get to that $5 plus range and guys start getting belligerent again around the drill bit. And so we'll see. It's bounced back a little bit. I think it's like 260 this morning on the next month. So I don't know. Natural gas is an interesting one. They call it the widowmaker for a reason. It's hard to predict.
All right, let's talk about the OPEC. I'm going to share the screen on OPEC oil production here. Because again, that's it is amazing. It's everyone, and you've seen this before because you've seen cycles, but everyone got so hyped up about energy and oil, especially towards the peak in June, right? Now people are kind of sanguine on it. I mean, it's always what happens. The narrative follows price. But let's talk about OPEC. I've got a chart here on OPEC crude oil production from Y charts. Yeah, still looking like it's on the uptrend, but now you've got some dynamics where the UK is going to have to probably force a recession to break inflation. Most of the Eurozone is in recession. You've got some really interesting conflicting demand dynamics, I think, when it comes to Europe in general. But what are you seeing with OPEC?
I think they're trying to front run a weaker demand scenario is what I would, there's a lot of people saying, oh, they don't have the capacity. They're not going to, they can't, they've been underproducing on their quotas. I think it's more like they're trying to get ahead of the market and they are seeing what, they're smart. They understand the dynamics of what's going on. Maybe they're seeing weaker demand. Maybe they're forecasting this recession and they want to get ahead of it. These guys need to be at a $80 plus Brent price for, a lot of these budgets to work. Saudi Arabia has a lot of ambitious plans. They're investing a lot of money in everything from building new cities to taking over the golf world. So, with all their programs, their social programs, their economic ambitions, they really need a Brent crude price at above $80 to make it work. And so we'll see. I think that these guys know what they're doing. And, I think they're trying to front run potential weakness in demand, maybe coming up later this year, next year.
But presumably they don't, they can try to front run it, but there's so much volatility and risk, both ways, I'd argue. I mean, you got seemingly more still upside risk when it comes to inflation in areas like the UK. You've got downside risk in a lot of other areas. So I have to imagine it's hard for their own models to even try to get a sense one way or the other what exactly to do.
Yeah, I would think so. But, to me, it's like these guys, they're not as afraid of the US as they used to be in terms of shale producers growing at the same clip that they were. I think that they feel like they're in the driver's seat. And, the game theory has always said, look, the prisoner's dilemma early on in the shale revolution, they were trying to break the US companies. I think they largely succeeded in a lot of ways. Guys continued to grow production. And then, the last couple of years, the capital discipline narrative and the ESG narrative and a bunch of other things have kind of played out a little bit to where guys seem to be more sober in terms of what they're doing on their drill schedule plans. And so now I just don't think that they're as afraid that if prices go to $100 or $110, that people are just going to go wild here in the US. They could be wrong. I mean, drill baby drill. These guys love to drill wells and that's at their nature. These capitalists here in the US, that's like what they like to do. But I just feel like OPEC feels like they have more control in the market. They have it's all finite supply. Yes, Saudi Arabia and these countries have a ton of oil reserves, but ultimately those are precious. And would you rather pump oil at $50 or at $100? And I think that the answer is they'd rather pump it at $100. So I think they're going to do whatever they can to prop the price up to a certain level. Last year, the US government with the SPR releases was a big factor. I mean, they were pushing a lot of barrels onto the market. At some point, they're going to have to refill that. Who knows when, but they've done a little bit of purchases. But I think OPEC just sees that they can control it, or they think that they can, and they want to nudge prices higher.
Let's talk about that because I put up the chart again from Y charts as I'm sharing my screen here. I haven't really been tracking what's going on with the Strategic Petroleum Reserve until just now, which I pulled it up. But I thought we were supposed to be refilling that at lower prices. Is that not happening?
It's going to be tough. I mean, we're going into an election cycle right now in the US. And so it's a really interesting time because the election cycle, I think, is going to have an impact on what they do with the SPR. Do they really want to be buying a ton of barrels and pushing prices up going into that? I would say that they don't. I would be shocked if they do it in a meaningful way prior to the election results. It's also interesting with what the Fed's doing with interest rates and where the economy is broadly. They really don't, the powers that be probably do not want a, major recession heading into this election cycle. And so I just have a hard time believing they're going to buy a bunch of barrels that could put upward pressure on prices, given where we're at politically right now. Could be wrong, but I would say that history shows that they're going to do whatever they can to prop up the economy here coming in the next 12 months.
Right. Actually, I've made that point before. People vote based on nominal, not based on real. So there is an incentive for the existing incumbent to keep the economy on a nominal basis looking strong, even if on an after inflation basis, it's not, at least until they pass the election.
Right. Yeah. I think that's where it's going to go. And I don't know what's going to happen with inflation. I'm not, I like to follow the macro stuff. I nerd out on it. It seems like we've rolled over. I think a lot of the housing data is going to start coming through later this year. And you're seeing downward pressure on home prices. Maybe not as much as people thought, but you're seeing some downward pressure on rents. And these things are on a big lag. So when that does catch up, I mean, if you look broadly at what's going on, I mean, look at commodities, look at, some things like the labor market may be still pretty strong. It's showing some cracks, but ultimately the basket of goods, I mean, prices have either come down or they've stopped inflating nearly as much. I mean, lumber, you talk about it a lot. We're seeing it. We're hearing it from builders in the home building space. They think materials costs are coming down on some things, not everything. They think labor costs could be coming down on the home building side, and so I just think that if inflation has rolled over, they're going to play that card. They're going to hope to keep it low. The last thing they want to see is, $120, $130 oil rolling into an election. So getting back to the SBR, I think that's a major thing is that if they can keep, the economy at least partially on the rails here, I think they're going to do what they can to do it.
So your point about housing, I think is worth noting. And I'll be the first one to say, as much as I keep on being very loud saying housing is fucked, which I do believe from a very long-term perspective, to your point, it's been actually pretty remarkable. So if you look at the Case-Shiller index as kind of a proxy on home values, I mean, you looked like you had peaked. Now you've got this little pickup here, right? Which I think Powell had kind of alluded to, right? It's like housing may be reaccelerating. Now, to some extent, you can argue that makes a little bit of sense, right? Because if I always go back to this idea that you need the illusion of stability for activity, the illusion of it. So if people believe that you're towards the end of the rate hike cycle, then there's a belief that mortgage rates have maybe debatable, right? But that becomes, so I think it makes sense that you would see some new activity on the hope that now the next move is directionally lower rates. So you start seeing some movement there. But to your point, this is still a very kind of strange dynamic. I know you're involved with real estate. You tweet a decent amount on that. Talk about just real estate from your perspective now. Forget about the Case-Shiller. What's your own sense of, housing, properties, and how that relates to inflation?
Yeah, I'd love to. So we, initially when I started investing in real estate, it was more on the residential side, single family homes. We're not in that asset category today, so I'm not following it as closely. I do know that there was a lot of price pressure last year when rates went up. Days on the market started going up. Home values started coming down. You stopped seeing these bidding wars, things like that. But ultimately, people have to find a place to live, and people don't want to move when interest rates are high, but some people are forced to move, and everything's supply and demand. And so as we see pressure on home builders, as we see like days on the market tick up, as we see pre-sales go down, like for new developments for residential housing, that's going to cause a slowdown. And, inventory is going to drive a lot of things. And there's still a lot of markets that are probably undersupplied from an inventory standpoint. So, I think right now, the real estate market feels like it's going through a new normalization and equilibrium around what is an acceptable mortgage rate. There for years, it was like, if you could get a rate in the 3%, that was a home run. And it was, given what's happened now with inflation. I think into the future, getting a rate around 5%, people are going to view that as more of a home run. And so what you start to see is when interest rates drop below that 7%, we kind of get into the low sixes. It seems like the market tends to stabilize around new applications for new mortgage applications, new buyers into the market. And so it's going to take some time. But I talked to a friend that's about 10 years older than me. And he's like, look, man, when I got out of college, he's like, it was pretty normal to see like a 6% mortgage rate. He's like, people weren't shocked by that, but people have been conditioned over the last 10 plus years, however long it's been, to get these really low rates. And it's just going to take some time for the new normal to set in. But it's one of those things that is an easy lever theoretically for them to pull. The Fed buying mortgage-backed securities. I mean, they can get mortgage rates down if they wanted to in different ways. And I think that if you're at kind of this like low 6%, call it mid 5% mortgage rate, you're going to see a healthier home environment. And really, that's kind of where they need to be. I think it's unhealthy to have mortgage rates in the 3% range. You just see prices going nuts. And so that's kind of where that's going. In my opinion, I think that, the story is the spread between the 10-year and mortgage rates. Typically it's been kind of around 2% or less. It's blown out. I don't know what it is today. I haven't looked at it in a while, but follow the 10-year treasury and you're going to see what happens with mortgage rates. And then in terms of the segment that we're in now, we're in short-term rentals and vacation rentals, which is really like a hospitality play. And there's a lot of doom and gloom on Twitter about that space. And I think that, The space has seen a lot more entrants come in terms of amateur investors getting in. I think it's getting more competitive, but I do still think it's healthy. I think that what you're seeing now in that space is you really have to be a sophisticated operator and you have to have properties that are purpose built for these types of vacation rentals. And those are doing well. I think Joe Schmo that just bought a house in a market that, had done well 2-3 years ago because there was no inventory. I think you're going to see some pressure there, but happy to get more into that space if you want. But that's kind of where we're at today on the real estate.
Yeah, no, and actually I see Charles from YouTube saying that Zillow has lots of overpriced homes for sale. And that's not just something that people say, right? I mean, if you look at home affordability, income to interest payment type of metrics, right? It's very clear that we're still in the top decile of expense. But the thing is, this stuff, as you know, Max, it takes a while to resolve, right? Which is why I think it's going to be tricky to try to play both ways, right? You can believe that housing is overvalued, but can be even more overvalued, just like stocks, right? Something that's overbought can be overbought for a long time.
Yeah, absolutely. And I mean, I've seen it. Like I've tweeted a couple times about, where home prices are today on new homes. I mean, look at my house, and I bought it in 2019, which actually turned out to be a pretty fortuitous move by us. And I thought at the time that we paid kind of top or close to top of market. I was worried about it, but it was a nice home. We really liked it. And it was a big decision for us. First time we moved in 7 years. And then now looking at what new homes that are right in my same area that I live in, right across the street in a new development, the price per square foot is nearly double what we paid. It would, to get the same size house, I would have to be paying almost twice or more than twice what we paid, which is just crazy. And then you couple that with, with mortgage rates. And so I actually had a broker come to me recently. He's like, hey, I've got this couple. They're looking for a house in your neighborhood. They really liked your house when it was on the market a few years ago. Would you guys ever be open at selling? Could they throw out a number? And I was just like, not really. I was like, they can throw out a number, but what am I going to do? I'm going to go turn around and have to buy the same house for almost twice the price at an interest rate that's over double what I have locked in for 30 years. So it's expensive. I mean, home prices are expensive when you look at affordability. You look at everything else. It's inflation matters. So it's not just the price of your mortgage, it's the price of your groceries and all these other things. And so it's like, I'll go back and look at my credit card bill from 2 years ago and look at the summary and be like, I don't feel like we're really buying more stuff. Why is this up 30%, monthly? And I talked to my wife about it. We're talking about budgets and she's like, it's just inflation. She's like, we're buying the same amount of stuff. It's just like, it's flowing through. And so when you think about affordability, it's not just the affordability of the house, it's the affordability of the American budget and of the household budget. And right now they're being stretched, in my opinion. And so that factors in as well on what people can afford when they go to buy a home.
Yeah, I'm trying to pull it up because I do think this is something that's also underappreciated, speaking about being stretched, which is you look at credit cards and credit card interest rates, right? You're pretty much at all-time highs. Now, the thing is, just like it takes, what's the expression, 21 days to change a habit, right? It takes time for people to change their spending habits, much longer, right? So the Fed is battling inflation with higher rates filtered through to everything in the economy. As revolving interest rates keep on going higher and higher, most people don't notice it right away, but they start noticing it when over time, the minimum payments keep on increasing, right? Relative to their,
right.
So, and that's where I think that's why I going back to your point about, consumer spending and how that relates to even the luxury rental side of things, I have to assume that no matter how wealthy you are, at some point, credit card interest rates start making you rethink some of your investment decisions and spending habits.
I think it does to a certain level. Like what I've always said, and I don't know if this is right or wrong, is that in these types of markets, and this is hearing like a lot of people talk about 2008, what happened, that was obviously a unique circumstance in the real estate space, but I would rather be playing at the very top end or the very bottom end when it comes to real estate and making these investments. Because the people at the top, and we're seeing it right now with the luxury homes that we do, we just brought a couple cool cabins, right? I call them cabins. They're really just like mansions online in this vacation rental market that we have. And we've had 4 or 5 people per one of them call us up. They're cash buyers that really like them. And we're like, hey, would you be willing to sell this? And it's like, well, clearly there are people that have lots of money. I don't think this stuff matters as much. Like I've got some friends that are really wealthy and it's like, talk to them about it. And like, they're going out to buy their wife the brand new Escalade. Like they don't care. If you're worth, $30-40 million, like you're going to buy the thing that you want. And so I think it's the people kind of in the middle that were reaching to buy that new house that really wanted they wanted to go from 2,000 square feet to 3,500 square feet. And they could have done it at 3% mortgage rates. Now they're looking at it and they're like, this is too far away. I think there's always going to be the need for affordable things. So stuff on the very bottom end, if you have a price advantage and you have a quality advantage, you can come in and offer something that's good quality at a really low price. I think that works good in this environment. I think it's the stuff in the middle. It's the stuff that people had to stretch for. It's the stuff that people probably shouldn't have been buying that house because, look, if the difference in 2 or 3% of a mortgage rate changes like the fact that you could even afford this house, maybe you should have been like not affording it in the first place. I know it's kind of harsh to say, but like if you're at the very top end of the market, and I've talked to people that are like real estate developers from 2008, and they were like, yeah, we were building, $1 million gardens in this house in Florida and spending all this money. And like that business didn't really slow down that much because it was these people that just had tons of money. And they were like, yeah, go put in a $500,000, backyard pool and all that $500,000 of landscaping and all this stuff. And so anyways, that's kind of my thought is that I think you would, in this environment, you'd rather be at the very tippy top end or you'd rather be at the very bottom. I think the stuff in the middle is where you're going to see a lot of pressure. I could be wrong. That's kind of my layman's take, but
yeah, the truth is that's an unfortunate dynamic that's always in play, right? I mean, you're basically at the core, it's a reflection of the widening wealth gap.
Right. Yeah, absolutely. And I think that from the vacation rental space specifically, what we've tried to do is make it even relatively affordable. If you look at like the cabins that we have or the homes that we have on a per bedroom or on a sleep count basis, it's like $300-400 a night for this incredible luxury place per couple that's staying there. So, I mean, I go and stay for business in Houston or in Dallas. I may get like a shitbox hotel for $350 a night, like in, downtown Houston. And I'm like, this is awful. Like the water stinks. It's a gross, like Marriott, Courtyard, whatever. I mean, I'm picking on them, pick another one, but they charge like $370 a night and then they tack on taxes and fees. And it's like, or you could pay $370 a night and stay in this luxurious place with your friends and family and get a pool and all these other amenities. And so it's like, you have to be conscious of not what we're charging on the rentals, but what we're charging on a per couple basis, on a per, paying customer basis, and keep that in line to where people can still have an affordable vacation where they can drive. And that's another theory that we've had is that the market we're in is about, if it's probably a 4 to 5 hour drive from like a radius of about 18 million people. So about the size of the state of New York, a little less. And so it's like, can we provide an experience for people during times when they don't have the budget? I mean, I've got 3 kids. Like we're going to go on a couple vacations this year just to fly them somewhere for 5 people. It's ridiculous. I mean, just the cost of admission just to get there is ridiculous. So having something that people can drive to, that they can split with a couple other families, and it still makes a pretty affordable vacation that's a great time. That's kind of where we're thinking in terms of how to position.
Yeah, that makes a lot of sense. That's a good place to end this kind of impromptu market chat. Everybody, please make sure you follow, if you don't already, Max Gagliardi here on Twitter, on YouTube, and anybody else that's here. Show positivity the way Max does, because life is short and you don't want to be an asshole to those that you never know who can help you and who you can help and vice versa. So thank you, Max. Appreciate those that tuned in randomly. And make sure you, by the way, everybody that's listening, click that notification button on my profile, on Max's profile for live videos, because we might surprise people. Try to do this whole surprise and delight thing.
There we go. Thanks for having me on, Michael.